What makes a backtest show a consistent trading edge? Imagine trying to find a trading strategy that works not just once but over and over again, no matter what the market throws at it. That's what a reliable backtest aims to show. When you test a strategy using historical data, you want to see results that are steady and repeatable across different market conditions. If a backtest only performs well in a specific period or on a few stocks, it might just be luck or overfitting. To really trust a backtest, it needs to prove that the strategy can handle bull markets, bear markets, and sideways trading without falling apart. One key factor is having clear and well-defined rules for when to buy and sell. For example, in stock trading or options, using signals from moving averages or volatility measures creates a logical basis for entries and exits. When these rules are explicit, the backtest becomes more objective and easier to reproduce. It's like following a recipe rather than guessing. Next, the data used for backtesting should cover a long period, ideally several years. This way, it includes different economic cycles and market regimes. Testing across multiple sectors or assets helps avoid overfitting to just one type of market. If a strategy only works on one stock or during a specific time, it might not perform well in real life. Avoiding bias and curve fitting is another big part. Traders should resist the urge to tweak parameters until the strategy looks perfect on past data. Overfitting makes a strategy seem successful but often fails in live trading. A good backtest tests the strategy without cherry-picking trades or adjusting rules after seeing the results. Incorporating realistic assumptions about transaction costs, slippage, and position sizes is essential. If these aren't included, the backtest might overstate potential profits. For example, factoring in commissions and bid-ask spreads helps reflected what can actually be earned. Managing risk properly, like limiting maximum drawdowns, ensures the strategy can survive tough periods without big losses. Performance metrics like profit factor, win rate, and risk-reward ratio help evaluate if the strategy is truly reliable. A profit factor above 1.5, combined with steady growth in the equity curve, indicates a solid edge. The goal is to see consistent gains without wild swings. Validation through forward testing or out-of-sample testing adds confidence. After testing on historical data, running the strategy on unseen data or in a simulated live environment shows if the edge holds up outside the original dataset. This step helps confirm that the strategy isn't just fitting past data but can adapt to future markets. Finally, including multiple relevant variables can improve timing and decision-making. For example, combining volatility, volume, and price patterns can make entries and exits more precise. But it's important not to overcomplicate, as too many variables can lead to overfitting. In stock trading, a backtest might involve testing a moving average crossover across many stocks over several years, including different market phases, and accounting for costs. In options trading, strategies like selling puts or calls, spreads, or straddles can be tested against changing volatility and time decay across various underlying assets. To sum it up, a backtest shows a consistent trading edge when it's based on clear rules, tested on diverse data, free from bias, includes realistic assumptions, and validated through additional testing. This process helps traders develop strategies with a higher chance of success when they go live.